to another edition of our live stream with Jeannie Olowski. For those of you who don't know, my name is Jermaine Evans. And Happy New Year, everybody. This is our first live call that we've had for the 2019 year. So we want to welcome everybody today. If you want to ask a question to Jeannie or myself, it is at *0. The operator will come on and then put you in the queue, and then you'll be able to ask any question that you have, and we'll be hopefully able to answer that. We actually got Jeannie off of her sick bed to do this call today, so I just want to let you know. So wish her, she feels better. She says she does. She was actually sick for a week, so when we missed her around here, so we absolutely glad that she's back. So this is a treat for those of you who are new. For those of you who don't know who Jeannie Olowski is, she has been raising money for Dave for almost 20 years. She's raised, and I want to make sure I get this right, about $180 million for Dave and his deals. So if you have any questions in regards to real estate, sponsorship, raising money, things of that nature, Jeannie is the one to call. So without further ado, here's Jeannie Olowski.
Well, good afternoon, everybody. Hopefully I won't be coughing on this call, and it'll be a pleasant surprise for both of us. So I hope everybody enjoyed their New Year's. Unfortunately, I was sick. I had pneumonia, and now I am at the tail end of it. I took my last antibiotic today, so hopefully I'm on the mend. Anyways, let's welcome everyone that started out with us from Dallas, Texas, and we welcome you aboard. We have a fantastic venue for you that you can call Jermaine or myself anytime in between your coaching calls or whenever you need us. We are here. We take care of primarily all of the coaching calls that come into the office. And we're happy to have you with us, and we'll hope we have a long-standing relationship with all of you. Upcoming events, excuse me, San Diego Immersion, January 11th, 12th, and 13th, and Dallas Immersion, January 25, 26, and 27. But I believe Jeff is out this week. He might even be in Dallas this week.
It's San Diego this week. If you look at the calendar, it says San Diego.
Oh, yeah. Okay. Yeah. I looked at the wrong button. So he's in San Diego this week. Sorry. I'm still in January 4th, 5th, and 6th, believe it or not. I was looking for it on my calendar, saying, why isn't the 4th on there? I missed that whole week. Okay, so we're going to do a high five today. High five goes to Steve Pike from San Diego, California. He recently purchased 34 units in Ohio. The purchase price was $1.15 million. Asking was $1.4 million. It was an off-market property that he got through a broker relationship. He raised the money through various investors. Value plays were to add the RUB system and replace existing management company. Congratulations, Steve. Now let's move on to the next deal. So a bunch of people have emailed in some questions, and I will answer them, but we're going to find out who's on the line that's going to be our operator today.
Hi, Jeannie and Jermaine. It's Rashawn.
Hey, Rashawn. Happy New Year.
Happy New Year. I missed you the last time I was on.
Oh, yeah. I need a little vacation.
Yeah, there you go. So could you let everybody know how to ask a question? And you can find out if there's anybody waiting now.
Yes, ladies and gentlemen, at this time, if you have any questions, please press *0. Again, *0 for any questions. And we do have someone in the queue. Our first question comes from Carlos. Carlos, please state your question.
Yes, hi. I was wondering, my question is, if I chose a market where you guys say ideally 8.5 to 10% cap rate, but the cap rate really in California, all of California pretty much, is from 4 to 5.5. What do I do? Like, I know there's a deal out there and there's other things we can do, but it's a little discouraging, and I don't want to just scratch surfaces in different markets like you guys told us not to do. So that's my biggest concern right now, is that the market area where I want to invest is just non-existent. Cap rate at 8 to 10% is big non-existent in this area, in the whole state of California. So what do you suggest I do?
So a lot of people are still buying in California, and they are finding motivated sellers who have run the gamut. They've owned the property for quite some time, and now they want to either retire or they want to sell and upgrade into something bigger. So there are deals to be found, and you can find them. I'm not going to say there's rampant deals out there with 10% cap rates in California, because it's just not so. But you will find motivated sellers that do have cap rates that you can live with and still make a good return on investment for your investors, and that's really what you're looking for. The Holy Trinity numbers are the ideal numbers. That's what we want you to look for. So it's an 8% cap rate, 1.6 debt coverage ratio, and a cash-on-cash return of at least 12. And that's to make sure that you can give your investors 8% and you can get 4. So there are multiple avenues that you can look for properties. You may not find something, but you do see a value play that will make it. So you might not buy it at an 8, but you may be able to put the value plays in gear and get something close to an 8 just by instituting a RUBS program or starting to charge for things that people have been getting for nothing this whole time. So if a property's been mismanaged in any way, and now they're, under new ownership, you're going to check the surrounding areas and see what other competitors are billing for in that area, and you'll start billing for them, and you'll be able to increase the cash-on-cash return immensely. So you might not buy it in an 8 cap, but you can make it an 8 cap. And if you are pretty open in communications with your investors, most of them are reasonable, and they know they might not get the 8% cash-on-cash return immediately, but within a year they'll be able to capitalize on it and maybe even exceed it. So
I guess with the help of my coach, because, every broker I've contacted, they sort of laugh at me when I tell them my cap rate. They're like, yeah, that's non-existent. That's not going to happen. So,
Carlos,
I guess with the help of...
Carlos, can I just say this real quick? Yeah, I was going to say, Thank you, Jeannie. Yeah, don't tell them what kind of cap rate you're looking for, because they're always going to laugh at you. What you're telling them, what you should be telling them, is you are looking properties with strong value add. Yep. They will understand that 100%. Whether it's a 10 unit or a 100 unit, they know value adds. And if they can see that the property that they're trying to peddle to you has a lot of meat on the hoof that the present owner isn't capitalizing on, that's a value play for you. But if you come out of the gate and say to a broker, listen, I don't want you to show me anything unless it's an 8 cap, they're not going to show you anything because they don't have anything and they think you're being unreasonable. So what you need to do is find the value adds that's going to enhance a property and make it better. Yeah, you don't want to tell them, like Jeannie said, you don't want to tell them that when your first conversation is, I'm looking for an 8 cap, because the first thing they're going to say to you is, I can't do that. There's no way I'm going to do that. And then what they're going to think that you're going to take away their commission, because that's basically what they're looking at. You got to look at it from their point of view. It's all commission for them. So if you tell them that it's an 8 cap that you're looking for, the first thing they're going to say is, I can't do it. This guy's wasting my time, and it's going to be hard to get them back on the phone after that. So make sure you, like Jeannie said, you want to make sure you tell them that you're looking for value adds in properties, or you could just do, find a deal, see if whatever criteria you're looking at. If you're looking at 50 units or 100 units, have them send you that information over. And then analyze it, and then if it doesn't meet the Trinity, then you look to see what kind of value adds are in that particular deal, and then then it's about negotiating after that. So those are the things that you want to do. So you don't want to giving them a cap rate is negotiating at a position of weakness, and you don't want to do that. You want to negotiate a position of strength, because you want to be able, once the numbers come out, to say to the broker, here's the reason why this property is not worth $5 million or $10 million. And then you can give them the reasons of why, you're looking at it, but after analyzing it, that it's not worth the $10 million that they're asking for the property. Does that make sense?
Okay, so that makes a lot of sense. My next question is, what do I tell them when they ask me what cap rate I'm looking for? Because most of them do ask me that.
So you just say, we don't work on cap rates. We work on cash on cash return.
Oh, okay.
We work on the cash on cash return because our main focus is to make sure our investors are reaching an 8% cash on cash return right out of the gate. So you can eliminate the sticking point of the cap rate. I know that's how brokers work, but that's not how you're going to buy.
Yep.
You're going to buy based on the value adds that you're going to implement. And it's all about the bottom line, cash on cash coming in to your bank. And if it's 12%, you know that you're going to give the first 8% to your investors. And the other 4% will either come for you directly, and if you need a sponsor, you may have to split that with your sponsor. But at least you know that you're going to get paid, and they're going to get paid. And that's how you want to talk to your brokers.
And another thing that I would say is, I would turn it around on them, Carlos. Is I would say, if they say to me, what kind of cap rate are you looking at? What are you looking for? I would say, well, what are the average cap rates that you're seeing in this area? Turn it around and let them tell you what it is. And then that way, once they tell you what it is, you already know what you're looking at, and then you already know where you have to negotiate.
Mm-hmm.
The most important thing is you want to control the conversation. You don't want them shutting you down because the answer that you're going to provide to them is not what they're looking for. You got to dance around the whole subject.
Yeah. Once they perceive a negative, it's tough to get them back on the phone.
Yeah. Okay. That explains a lot.
And if you want to buy in California, you really need to start looking for those motivated sellers. And if you can't buy in California because there's nothing right now, pick a secondary market somewhere and come back to California when things are opening up. I mean, California is going through a lot of hiccups right now.
Well, the problem is when you're a beginner like myself, going to a market where it's far away from you, it's a lot harder to get your team together. And I mean, that's the way I look at it. It's a lot harder for me to look at Birmingham or look at Dallas or look at, other places because it's so far away.
That's what you have us for. That's what you have us for. We have people in every single state of this union. So, I mean, if it's just a distance thing for you and not an emotional attachment to the state of California, get over it. Start getting
I don't.
some traction and produce some results that's going to pay you back the money you just paid us to be in this deal. So That's the most important thing. You want to get paid. You want your investors to get paid. You got to find a deal in the right market so that you can capitalize on it and grow. You want to grow a business.
Win-win, Carlos.
Yeah, I'm all for it. So that's why I'm asking questions. So yes, okay, good. That answers my question.
Okay.
Awesome. Awesome. Thank you so much.
You're welcome.
Problem. Thank you. Good luck.
Our next question comes from Jawan. Jawan, please state your question.
Hi, yes. Hi, Jeannie.
Hi, Jawan. How are you?
I'm good.
Hey, Jeannie.
Good.
Jeannie, we have to congratulate Jawan. She closed on the 3-unit in Ohio. So congratulations, Jawan.
Awesome, Jawan.
I actually took your advice. You said, well, go for it. And I said, so I closed. It's an owner finance deal. It was the easiest thing I've ever done in my life.
Awesome.
0%.
So now go and rinse and repeat.
Yes, that's exactly what I'm trying to do. But one of the questions I had, because I listened to the replay last week, which was very, very good, and, you're talking about you went through the rent rolls, and one of the units, because Cincinnati rents are kind of high, one of the units is about $300 too low. So when you acquire a new property, I was just kind of wondering, because you don't want to run a tenant away or, of course, raise the rent $300 to you. I was wondering just some feedback on how do you handle raising the rents, without running the tenant away or making a move, and do you do it 30-day notice? Just some feedback on how you get the rents up to the market rate.
Well, it's going to take you a while to get a $300 upswing in that rent. And it might take a couple of years to get $300 out of them. But if they're good tenants and they pay their bills on time, you're going to send them over kind of a schedule. And you're just going to let them know, our costs are different. You're going to see a lot more improvements around here for the properties. Effective, give them a month. Your new rent will be, say, $50 higher. They expect it, so don't even think that they're going to worry about the $50 because they expect it. And then just each year you're going to have to just jump up and hopefully provide services that they're going to be happy to pay it, because if they're going to go next door and have to pay $300 more for the exact same thing that they're getting, they're not going anywhere. They're going to stay right with you. So if you treat them like you want to be treated, but still have an upper hand on getting control of the differences in the rents, you should have no problem.
Okay, that makes sense. Okay, perfect. Thanks.
Okay. Congratulations, Joanne.
Jawan, make sure that you can't raise the rents if they have a lease, though.
They're on a month to month.
Okay, all right.
Well, that has to end.
Moving them to a yearly lease, is that?
Of course.
Yes.
Yep.
You have to put them on a lease because you're at risk. If you have them on month to month, they could leave at any time without consequences. And you could be faced with 3 months worth of rehab getting it ready for the next person. So they have to be on a lease, and you have to maybe give them a menu of gifts that if they sign early for say do a 9-month lease and then get them to sign for a year lease, just stagger it out so that you can consistently increase the rents.
All right, gotcha. I'll have that discussion with the property manager. Okay, great.
Hey, great job.
Okay, next on the line we have Ian. Ian, is your question?
Good morning. Happy New Year, and glad you're feeling better. So glad to hear from you.
Thank you.
The question is, it's a little bit of a follow-up to Carlos's statement. I live in San Diego, and I'm getting the same kind of thing starting, is most of the deals that I'm seeing that are selling are on the 5 or 6 cap rate. So what I've done is gone just a little bit further out. I don't want to go quite a ways out to, say, Visalia, but I'm looking a little further north and south of San Diego to submarkets that are having better deals. San Marcos Vista, Escondido to the north, National City, Otay Mesa, Chula Vista to the south. And it does involve digging a little bit deeper, and it definitely involves some rehabs and some micro rehabs because the good deals are just not here to be found. You're not going to find low-hanging fruit.
Right. Well, that was very nice of you to help Carlos out that way.
Well, and also checking in to check my logic, because that's where I'm headed. Does it make sense to do that? Because for me to go further out of the state, logistically, is a challenge. So I may not find the ideal case, 8 cap, 9 cap, whatever. But to start out, I need to build credibility with my investor base and also the broker base.
Right, and your investors are going to understand that you're doing this for them to make sure that they're going to get paid. So if you go into a marginal deal and they are not going to get the usual 8% preferred rate of return, so they're only going to get 5 or 6% the first year, but boom, they're going to get 9 or 10 the second year because things are going to happen. You're going to fix things out. It's all about building confidence with your investors, making sure they know that you're not only working for you, you're working for them too.
Perfect. Thank you.
Mm-hmm.
Hey, Ann, this is Jeff. I just jumped on the call. I'll see you on Friday at the San Diego Immersion Training.
Good. Perfect.
Yeah,
Looking forward to it.
Yeah, definitely.
Okay, I believe someone just hit the queue. I'll go ahead and grab them. Again, ladies and gentlemen, that is 0 for any questions.
So, Jeannie, how are you feeling?
I feel all right. I just took a lozenge, so
Oh, okay.
I think I feel okay.
Actually, you're not as bad as I thought it was going to be.
Have one of those cupcakes. You'll feel a lot better.
Well, I'm halfway through my orange, so when I'm done that, if I feel like it, I will.
There's a lot of goodies in here.
Okay, next on the line we have Meredith. Meredith, please state your question.
Hey, Jeannie. Hey, Jermaine. How are you doing?
Hey, Meredith. How are you?
I'm doing
How's
okay.
the family?
We're doing good. We are actually back in Texas now, but we went to Missouri hoping to see snow. We really didn't see all that much.
I hope you want to see a property, not to see snow.
As a matter of fact, we did. We actually went up there and we saw property. As we were coming back, we actually saw snow in Oklahoma, and that was unexpected because when we went up there was no snow. We were up there for about 6 days. We came back, there was a lot of snow all over the ground. So yeah, that was great. I had a question. If we're actually basically on those cap rates again, and you can help me refresh my memory, based on like cap rates, if we're looking at a property that just hasn't hit that Trinity yet, but it's looking at about a 6% cap rate to start off, but it won't actually go over the 8% until about year 5. Is that way far too out, or as long as we can show that in our with our numbers to make those work, is that something that investors would still work with us on, or is that an okay property to look at?
Boy, that's really marginal to make somebody wait 5 years to get an 8% return on their money. I don't know. I think it's too long, but, it all depends on who you're talking to. You could be looking at somebody that just needs to park money, or he's going to pay a big capital gains tax, or it just depends on the individual investors. But I think if you're coming in at 6% and it's going to be 5 years before they hit 8, I don't think that's something I would do.
Okay, and if how long do we want to wait? So if you have like a 6% and say it takes 2 years, that's okay for them to see that return that's on there, but not 5.
It's up to the people that you're talking to and the investors and why they're parking their money with you. People put money into deals for multiple reasons. One, they're trying to do a 1031 exchange so that they avoid capital gains. Two, they're coming of a retirement age and they've got to make their money work because they're not going to be getting paycheck after paycheck. So it just depends on who you're talking with. But for general, I mean, our students are pretty educated. I mean, if you were going to show them a deal that is starting out at 6% and it's going to be 2 years before they hit 8%, you might be hard-pressed to get that deal closed.
Okay, so 2 years is probably too much as well.
In my opinion, it is.
All right. All right. That's what I need to know. I appreciate it.
Okay.
Okay, thank you.
Our next question comes from Mark. Mark, please state your question.
Good morning, everybody. This is Mark out here in Albany, California. And just if I could ask two questions real quick. The first one is a broker sent a deal to me. Please let me just perhaps I'm a new investor here in the program. And so she sent me an apartment, 16 units, but 8 of the units are Section 8 renters. Should I be dealing, as a new investor, should I be dealing with any properties that are dealing with Section 8 housing?
Well, in my opinion, there's no problem with Section 8. Out there in California, you have something called rent control. That's a different story. But if it's just a regular Section 8 tenant and they pay anything, even if it's $25 a month towards their rent, I don't see a problem. But if it's under a rent control thing, you really better study it because it could be 15 years before you'll be able to raise the rents on any of those.
Or longer.
Okay. All right, thank you. And the second one, just really quick, if you could make a couple comments regarding the recession. I have heard some reports and a couple people are saying that 2019 we're going to get hit with a recession. And I'm just wondering, like as a general thing, just from all of your experience, if we're going into a recession, is that how is that like a negative or any positives for multi-family investments?
Wow, that's a loaded question. I mean, I do not have a crystal ball. I can tell you that I'm pretty old now. I'm like over 68, so I've seen recessions come and go. And yes, they get hit hard, but people learn to adapt. And I really, I don't see it coming. The economy is very strong. Interest rates just took a dip. Stock market is back up. I mean, I don't see it, but I don't have a crystal ball either. But if you're a multifamily owner and you own it now, and your tenant base is such that it's a couple, maybe no kids, and they plan on living in that apartment for a long, long time and weather the economy, I just really don't see a recession in view.
Okay.
What she's saying is that we don't have we can't tell whether or not that's going to come. I mean, eventually, this is the world we live in. Is something's going to happen, but we don't know if it's going to happen next year, 2 years from now, 3 years from now, 10 years from now. So it'd be tough for us to make a determination on whether or not. That's what the speculators do, and we're not a speculator, so.
And I can tell you the last recession that we went through, 2007-8 period of time, what we did was we wrote a note to all of our investors explaining that they wouldn't get any cash flow until things improved. And what we did is we shored up all our properties. We put money into them to make sure that they were good and hardy and could sustain losing a few tenants if they had to move home to their families or whatever. And we did not lose one property back to the bank because of this. So it's all about communication. It's all about preparation and basically what you're trying to do.
Okay, great. Thank you so much. All right, y'all take care.
You too.
Good luck. Sean, do we have any other questions?
Okay. Yes. Our next
you and I,
question
Jeannie, have the same brain. Except that.
Zane, please state your question.
Yes, Jeannie. Hey, it's Zane.
Hi, Zane. How are you? It's been a long time.
Yeah, too long. I am well. Thank you very much. And trying to, hit the bricks out there, so to speak. And just had a quick one for you. You had one of the other callers had mentioned that maybe 2 years to wait on any cash flow was too long to wait. Unless I'm assuming that it's a value play, and that was the plan from the beginning, that it might take you 2 years to even 2 or even 3 years to build the base up, the rental base up, the income base up, to be able to start returning that money.
It's very true. But if you're looking at something and it's cash flowing 6% and it's stabilized right now, and you still can't get the 8% return to the investors, 2 years is too long, in my opinion. I don't. No.
I get it. I just wanted to make the distinction in my mind, and for my own case, is that my mind as to whether it's a stabilized property, or whether you've got, like I said, a value play that you're putting some money into, and it might be a couple of years before you're returning that kind of return.
This is
That's
true.
all.
But
I just wanted to make sure.
Right out of the gate, Zane, you have to communicate that fact to the investors even before they give you any money. You have to tell them
absolutely
what the plan is.
Communication. Right. Very good. That was it. I just wanted to kind of make sure that I've got it in my mind here, is that if I was putting money into something and knew it was a deep value play, I might not expect money back that first year.
Well, that's big of you, Zane. It's big of you. Not everybody's as generous as you.
Yeah, well, that's why I'm living on beans and rice and beans right now.
Right. Happy New Year to you, Zane.
Happy New Year to you. See you guys soon. Bye now.
Have a good one, Zane.
Thank you. Bye now.
There are no further questions at this time. Again, ladies and gentlemen, that is *0 for any questions.
Okay, I got some questions sent in to me. The first one is from Carlos Ortega from Denver, Colorado. How does using a real estate agent versus a real estate attorney differ in the cost to the seller? I assume I only need one to write the contract. Well, first off, Carlos, this is multifamily. The broker's going to bring you the deal. You're going to go in. You're going to do your due diligence. You're going to inspect the property. The broker could do the contract, or you could do the contract yourself. You want to put your earnest money deposits in with the title company, but you still need a real estate attorney. You need a real estate attorney that's going to advise you and be on your side, because the seller is going to come with his own attorney and his own real estate broker. So not that you have to pay another broker, but you really should have your own real estate attorney available, especially if you're going to syndicate the deal. You're going to have an SEC attorney as well as a regular real estate attorney, because contracts, they're big. They're not like 10 pages like a regular single-family contract. I mean, they could be 50 to 80 pages, and you want to have somebody on your side looking at these documents for you. You want to add anything, Jermaine?
Not only are they big, they're binding. So you want to make sure that you got somebody who understands the law and especially the law in that particular state, and who can help you to navigate through that. Because if you're investing in a different state, let's say you're from Colorado and you want to invest in, I don't know, Florida, you have to find somebody who understands Florida law, real estate law, so that way you're not stuck with something, or making sure that everything, all the I's are dotted and the T's are crossed. So always get yourself a real estate attorney. And if you're going to syndicate the deal, like Jeannie said, you want get yourself an SEC attorney.
Okay, so my next question is coming from Terrence Simmons from Upper Marlboro, Maryland. Good morning. Oh, he writes, Jeannie or Jermaine. I'm ready to ask for assistance in setting up our holding company, LLC. I or we prefer to use Delaware. I remember from the boot camp, Steve recommended using a lawyer due to the
intricacies.
Thank you. Of the operating agreement and the articles of organization. Is a lawyer necessary? Does RE Mentor have a standard template for the operating agreement and the articles of organization? Number one, first and foremost, no one should use any template for an operating agreement. That is how you are going to run your property. Each property is different. Each bylaw is different, and you cannot use somebody else's template and fill in the blanks. You must have your SEC attorney create that operating agreement for you. I would suggest that you reach out to Deborah Lewis. She is with Anderson Advisors. She's Clint Kuhn's assistant. Her phone number is 800-706-4741, and she can help you to get your LLC created properly and the way it should be done. Nobody should be cookie cuttering any LLCs for you. You must have an attorney do it. There's a lot of attorneys that can do it. We recommend Anderson Advisors. They're very good. They take care of the students. We also have Robert Bloom, who also takes care of students. So you want to have that LLC created by a legitimate LLC creator. So no template for operating agreement at all. No template for articles of organization. Those all have to be taken care of by an attorney, because you could have headaches galore. If there's even one comma out of place, it could read differently, and it could disrupt the whole property.
Plus you want to be able to have, like Jeannie said, certain things, certain bylaws, state bylaws, you have to abide by. So you want to make sure that you protect it. I think some people, and actually Bob Bloom or Robert Bloom actually hit me to this idea that you think just if you go to a certain, like if you use a LLC in Delaware, that you're protected, or even Vegas, and that's not necessarily the case. So you definitely want to make sure that when you're opening your entity, your LLC, or your you incorporate or whatever, that you have the right protection for you in your business. So actually, Bob Bloom actually did a coaching call for us. So you might want to go into the archives of the coaching website and actually look for that particular call. I can give you the date right now of when that call was done, and I'm just looking at it. So that call was done on, can't seem to find it, but it's up here somewhere. But he did a call either, I believe, at the beginning of last year. He did a call with us on, it was February 27th. He did a call with us on how to start your LLC, who should be in the LLC, the types of LLCs. So if you go to the coaching website, www.masterytrainingcenter.com, click on the tab that says calls, hit recent calls, and scroll down. You will see February 27th, 2018. Our attorney, Bob Bloom, did a call in regards to LLCs. So you can listen to that and learn all you can about LLCs.
Thank you, Jermaine.
You're welcome. I try to be helpful, Jeannie. Sometimes I'm not, but I try to be.
Rashawn, do we have any other questions?
Yes, our next question comes from Natalie. Natalie, please state your question.
Hi, I had a question. I'm in Florida, and I was presented about 100 unit in Palm Beach, where it's in a D area, and it needs a lot of work. But they're selling at a cap rate of 11%, and in the area, it would be really good for Section 8. And I was wondering if there's something that I should pursue or not, even if it's in a D area.
Is this your first deal?
Yes.
Run the other way.
Run the other way.
Yeah. It's true, because you're going to get so overwhelmed and frustrated trying to get to the property up to spec and making sure that it's good. But if it's in a D area, what's going to prevent it from going downhill again? I would not recommend, if you were seasoned and had 4 or 5 cash flowing properties that were paying you on a consistent basis, then I'd say, hey, jump off the ledge and go for something like that. But if it's your first property and you haven't made any money yet, oh no, I don't recommend it. Open up, guys. Okay. I'm wide open, Jeff, Jermaine. If you have something, all right.
One thing you want to do is, right, because the biggest problem is getting a property management company that will go into that area. So you're going to have to do a lot of research to see what the availability is for property management companies. So you probably want to go to your apartment association and get some recommendations for property managers in that area, or you can go up to IREM.org and see if there's any. How many units was it that you were looking at?
100.
Oh, 100 units?
Yeah.
Just go see if anyone from IREM. But that's the biggest. Not only is it the risk that Jeannie was talking about, but the thing is, like, there'll be property management companies that will not go into those type of areas. That's one big hurdle.
And you might want to also Google that property and hear what tenants have to say. And that's like a mouthful for you. If they're telling you that there's a lot of animals running around and, a lot of things going wrong with the property, I mean, think about it. Do you want your kids living there? That's my benchmark. If I won't let my grandkids sleep there, I ain't buying it.
Okay, thank you.
You're welcome.
So basically, do the research, Natalie. Find out what kind of deep property it is, and if there are going to be management companies that would be willing to go into it. And then if they tell you no, find out why. And that way, the next time you find something in that particular area, you know exactly why it's not worth even moving forward with.
Okay, that's a good advice. Thank you so much.
You're welcome.
We used to buy F properties.
Yeah, they did, and I didn't want to go there.
We used to buy F properties, so, like, you don't want to, like, that's what we say, be cautious of D's, don't buy F's.
Mm-hmm. Anyone, Rashawn?
Okay, our next question comes from Michelle. Michelle, please state your question.
Hi, everyone.
Hi.
I have, my question is, we've been submitting several offers, but none of them which have been accepted yet. But my question is, once we get them accepted, and we're on a shoestring budget, so what is legitimate in terms of where we could get our earnest money deposit from if we don't have it in the bank already?
Well, there are plenty of people that would be willing to give earnest money deposits for certain amounts of interest that you pay them. Typically, the earnest money deposit would be 1% of the purchase price. So if it's a $30 million deal, you're looking at $30,000. I mean, if it's a $3 million deal, you're looking at $30,000. So you need to start rubbing shoulders with people, start talking to people about the kinds of properties that you're wanting to purchase, and try to find somebody that can partner with you that has the wherewithal to put up the out-of-pocket cost.
Okay. Well, we do have some people that are looking to sponsor our deal, so it's legitimate to get money from them. I guess I was concerned about SEC regulations and things like that, so that
SEC has nothing to do with earnest money deposits.
Wonderful. Okay. Well, thank you very much. Okay.
You're welcome.
Thank you. Any other questions, Rashawn?
Next question. Yes. Sorry. Our next question comes from Brandy. Brandy, please state your question.
Hello, Jimmy. Hello, Jeff. Hello, Jeannie. This is Randy calling from California. How are you?
Hi,
Hey, Randy.
Thank you so much for that fruit basket you sent me. I appreciate it.
Hey, anytime. Appreciate it so much.
Fruit basket is the first time I'm hearing about a fruit basket.
Well, you guys left early the day before Christmas. I happen to be here.
Oh. Ah. Well, Randy, thank you for giving Jeannie a fruit basket that she didn't share.
I did not share it. My kids enjoyed those pears tremendously.
Nice.
Oh, I know Jeannie is going to share it with you guys. That's why we sent it. She always shares stuff with people. Thank you so much. I had a quick question, you guys, Jeannie or Jeff or Jimmy. How I've been hitting with quite a few of these matchmakers, so-called. You know, they find you out from a lot of connection on the web, and they're trying to hit you with say you have to have this deal, that deal, and then you work with them, tell them which state you're in, and then they send you something like, oh, this is an out-of-pocket deal, you know, and with some generic costs and thing, no data. And do you suggest us to entertain and work with them at all, or just ignore them?
No, if it sounds too good to be true, it is too good to be true. No, you don't want to work with a matchmaker. You want to establish relationships with brokers so that brokers like you and they want to see you successful and they want to get paid and they want to see you get paid. A matchmaker, there's no relationship there.
But they say they have deal to send it to you, so it's just like tempting to analyze their deal, whether it's worth to spend time with, you know, pursuing that deal or not. If
I told you I owned the top floor of the Chrysler building, would you believe me?
Yes, I might.
Well, I don't. No, I don't want you to buy into those kind of things, Randy.
Okay, so you just totally just ignore them or say no, shy away, and don't spend time, you know, I guess.
Just say you're working with existing brokers that have pocket listings that they want you to work with them on. And then just utilize Jermaine and I here in the office. We're willing to help you, Randy, anytime, but don't buy into some matchmaking that is not going to happen.
Oh, cool.
All they're doing is looking for a way to make money.
Randy, are they matchmakers or wholesalers? They're probably wholesalers, huh?
I don't know. They call themselves matchmaker, and some of them
I think that's the new name that wholesalers are using now. So more than likely they're wholesalers.
And somehow they find you. I don't know how to wear it. They just, hey, I heard you. You know,
I heard you're looking. What's your criteria? Yeah. I can tell you what the conversation is.
Yeah.
What are you looking for? Oh, really? Okay. All right. What are you looking to pay? Yep.
Yeah, exactly. They want you to pay. Second question I want to, I don't know if I should ask or I should follow with the the IRA accountant, the IRA attorney or something, regarding
just ask it,
our,
and we'll tell you.
Huh?
Just
okay.
ask and we'll tell you.
Okay. Which is confusing, reading books and trying to find out our own 401k and roll over and then trying to invest in. And we learned that we have to pay tax on it. And some of them you can form solo or you can form your own self-direct IRA, all that. And I'm just confused, like, what is the proper way to do it so we don't have to pay taxes?
Okay, so you can roll over money from your 401k, which is probably housed by Fidelity or Ameritrade or any one of them. The minute you withdraw the money, you're subject to taxes. So you want to do a rollover. So you need a custodial account to be in place to help you roll your money from the self-directed from where it is right now, Fidelity or wherever they house it, into a self-directed custodial account. Once it's in the custodial account, it is safe. And then you can invest in somebody else's deal. The only stipulation is you cannot be the managing member of an LLC that you're taking your 401k money and putting it into. So you can be a member of somebody else's, but you can't be putting it into your own deal that you are the manager of. If you have someone else as the manager, like say your great uncle, you can do that. But if it's anybody up and down the lineage, mother, father, sister, brother, blah, 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 you cannot take your 401k money and put it into a deal where any one of them is a managing member. That's just the rules that they put out there. But I would caution you not to take money out of anything. Always roll it. Don't take it, because the minute you take it, you're subject to those taxes. So if you just roll it from where it is right now to where you want it to be, then you can set up a self-directed IRA for yourself.
Yes, we did that. That's the way we understood it from the beginning. When we rolled over, we do some small deal, and then we learned that we have to pay some taxes because the IRA account that we formed, the self-directed IRA we formed. And by reading some book, it says you don't have to pay taxes only when your IRA account is solo. And I don't know how to form that, all that. I'm trying to understand that also.
So where did you put the money, Randy?
Through a custodian, self-directed IRA, regular self-directed IRA account.
What's the name of the company? What's the company that you...
A self-directed IRA. That's the name of the company, I think.
Well, there's a lot of self-directed IRAs. There's like 75 of them. So if you took the money from your 401k and rolled it into a self-directed IRA that is housed by a custodian, that's what you needed to do. So it could be Equity Trust, iPlan Group, Midland IRA, Ameritrade. It could be a number of them.
Yeah, indirect. UDirect.
So all you have to do is call them and find out why they're asking you to pay a tax, because any monies that get paid out on a property to you has to go right back into the self-directed IRA. So if you took $100,000 out of your 401k and rolled it into a self-directed, any monies that come from the property you invested must go right back into that self-directed IRA, or you'd be subject to taxes.
That's the way I understood it. But also, because if you self-directed IRA account, what I read the book, it says you have to pay taxes on the money you earn. Some of them, some percent of it.
No, you don't pay taxes on the money. You pay fees to the self-directed IRA people. You don't pay taxes on the money until you take it and use it for whatever you want. But any money, so if you invested in one of Dave's deals, say he gave me $100,000 and we paid you $8,000 the first year, that $8,000 must go right back into your self-directed IRA account. You can't use that money. That is money that is your retirement. So the minute you spend any part of that $8,000, that's the tax you're going to pay.
Yeah, that's the way I understood it. However, the book says a different way. So I don't want to take up the time.
Don't read the book. Don't read the book. Yeah. Call somebody. Call your account rep, and they will explain it like I just did. Probably a lot more eloquently than I did.
Okay. And is it because the deal has a bank loan? That's why you need to pay taxes, right? That's what I understood.
No. You invested money into someone else's deal, right?
Right. Mm-hmm.
So that money that they pay you, they should be wiring or mailing directly to your self-directed IRA. They should not be sending you that money at all. So there wouldn't be any mishap in you spending it by accident.
Okay. All right, I won't take up the time. One last thing is to confirm that you're saying you cannot get your own money to put in your own deal. That's what I understood, right?
Right. No, you can put it in your own deal, but you cannot be the managing member of that deal. So if you have a sponsor and the sponsor's the managing member, you can do that. But if you do not have a sponsor, then you're the managing member or your brother is, you cannot put money into it.
Okay. Thank you.
Okay.
I don't want to hold up.
All right.
Thank you so much.
Okay.
All right.
Take care.
Bye. Take care.
Bye.
Be well.
Thank you.
Good luck, Randy.
Thank you. Thank you, man.
You're welcome.
Any other questions, Rashawn?
Yes, our last question for today comes from Meredith. Meredith, please state your question.
Hi, guys, again. Hello. This popped into my head. I wanted to ask, we ran through a couple of properties when we were looking, and my question is it okay to look for properties that have like an MLS, a multiple listing service, where a realtor's involved? If so, how do we work that fee into our underwriting, or where would it go?
Wait. So if the property is listed up on MLS by the listing broker, if it's a listing broker, Meredith, if it's a listing broker, those fees are paid for by the seller. If you bring in your own broker to work a listing that you see on MLS, then you could be responsible if the listing broker doesn't want to share the commission. So what I would say is if the listing broker in MLS is the person you're working with, you don't have a problem. If the listing broker is not the person you're working with, then you'll have to put those fees into closing costs other and raise the money from your investors to cover those fees.
Okay, that makes perfect sense. Okay, all right, that's what I needed to know. I appreciate it. It seemed like it was pretty simple.
Yep.
Thank you.
Thank you.
All right, guys. So there was a couple of questions that were not answered, and I'm not going to take the time to answer them on this call as we have a guest here, and I wanted to be able to spend a couple of minutes with them. So I will take and answer these questions directly to the person that wrote them so that everybody's question got answered. All right?
All right, everybody. So,
all right. Thank you for listening. Thank you for listening. Hopefully you got something out of today's class. We had a lot of participation from Jeff, thank you, and from Jermaine as always.
Thank you. Hey, don't forget, guys, your R equals C times F. Those are due every week with your coach. So if you're not sending those into your coach, make sure you do that, because we want to make sure that you're doing what you're supposed to be doing and out there actually acquiring property. We want to see how you're doing and what we need to do to make it happen for you. So get out there, do those R equals C times F. And if you have any questions or you need the form, just send me an email, send Jeannie an email or Jeff an email, and we'll get those forms out to you, okay?
And if you want to see an example of somebody that is very diligent in doing it, and I can show you how they submit theirs to me, and they're like amazing. It really gives you a bird's eye view into what they've done for the last week or so that you've talked to them. All right. Everybody, have a good day. Thank you very much for listening, and we'll see you next time.
All right, guys. Have a good one.
Thank you. Bye-bye.